dimensions.
Mahindra and Ford have entered into a JV to develop, market and distribute vehicles in India. M&M will hold a majority stake in the joint venture and will invest 650 crore rupees in partnership. Yatin Mota caught up with Pawan Goenka of M&M and Jim Farley of Ford to understand the different synergies that the two auto companies expect from this India JV.
So the total enterprise value that we have agreed to is 1925 crores, out of which about 636 crore will be coming in from FIPL as debt into the company. That means current debt of FIPL will get transferred to the company. The remaining 1200 odd crores will be the equity that the two partners will put in. Mahindra will put in 51% of it, which works out to a little over 650 crore, and Ford will put in about 640 crores roughly, which is the 49% of that value.
You were talking about the large export opportunity that will be available to the joint venture. If you could tell us what kind of a geography does Ford already service from the India plant, and moving ahead, what kind of opportunity do you see from the export markets?
So right now we're exporting in more than 70 countries from India. We're the #1 exporter here, as you know. The opportunity is much bigger. In fact, we formed a new group called the International Markets Group, IMG, just for this type of opportunity. And it's over 100 countries. It's the Gulf States, it's ASEAN, it's the Africa, including a signature market, South Africa. It's even mature, smaller markets like Australia and New Zealand, where we're #1 and #2. These are all very important markets for us, and these would be the type of markets like a Mexico that we could export from India.
Dr. Goenka, you in the press conference mentioned about scale and the kind of benefits that you can get in terms of the synergies. Talking specifically about synergies in terms of procurement, especially to do with material and having locations in Chennai as well as probably in Gujarat. How do you really see the entire ecosystem shape up for the joint venture, and what kind of a synergy benefit do you see coming in the medium term?
So there are three areas where we see synergy benefit coming in. The first one is in product development itself, where probably we will get, for a common platform being shared between Mahindra and Ford, we'll probably get about a third to 35-40% kind of reduction in investment, which is quite significant because that means about 400 crore or thereabouts for each new product that we do. The second one is in sourcing, because when we combine the volume of Mahindra and Ford, the volume, let's say, doubles for the same platform. That means the tooling cost that we have, the overall overheads that the supplier would have, will get distributed over a much wider volume base, and that gives us benefit in terms of sourcing cost. Manufacturing, there are best practices that Mahindra has, best practices that Ford has, and there's a mutual learning that Mahindra and Ford would have on that, and reduce manufacturing costs. So if you combine the three together, that could be significant saving. Of course, we have not quantified it because we'll have to see. We don't know what inefficiencies there are that could be removed. Maybe there aren't any, maybe there are many. We don't know that yet. That we'll know only after we get into it.
What makes you keep out the engine portfolio as well as the smart mobility solution business out of the joint venture? And if you could also talk about the electric vehicle portfolio. Mahindra, of course, is a pioneer in India with respect to electric vehicles. How do you really leverage that portion of the business that would be outside of the joint venture?
Okay, lots of questions there. So the first is mobility and engine. Most of the Sanan engine capabilities actually export already. So it's not naturally the type of powertrain that fits the JV. So that's very natural. Smart mobility is just early days. It could easily be an option to roll into the JV. It's just too early, but it's going actually really well here in India, but it's just early days. And your third question?
Regarding the overall electric mobility, products. That
so Ford is betting big on electric, like most companies, and we're really excited about Mahindra's leadership. Pawan and I were just talking about despite the challenges in the market, the success Mahindra had last month in electric sales. Our portfolio of dedicated electric platform is really on much larger vehicles for Western Europe and the U.S. The opportunity here is to work together for battery electrics in the emerging markets, which is actually an opportunity that Ford hasn't really addressed yet. So we're really excited about this electric opportunity with Mahindra.
Dr. Goenka, if I may put it so, we are under a temporary slowdown. There is a lot of idle capacity in the industry. Auto companies are struggling to, maintain their profitability, which they saw in the past couple of quarters or past couple of financial years. You will have some idle capacity once, these two plants come under the joint venture. In terms of profitability and EBITDA contribution, if you could just give us a flavor as to how will the financials work?
Well, clearly in this case, the two coming together cannot be in any way detrimental. Ford alone was doing something, Mahindra alone was doing something. Together, it cannot be worse than what it is today. Okay. What we are hoping is that as we launch new products, for the current products, it will make no difference. Ford will do their product in the Ford plant, Mahindra will do their product in Mahindra plant. But for the future product, when we launch a common platform, two different products, then they'll be made in the same plant, whether it is a Ford plant or Mahindra plant. And that's when we start seeing the capacity utilization improving much more than what it is today. The current slowdown can never be a reason for doing or not doing something, because that's a temporary phase. And such discussions and partnerships are for very, very long time. And therefore, current slowdown doesn't really come into the picture.
And one final question on the branding. You said that you will house, the brand separately. You will continue to market your products separately. But how do you cross-sell products? Will it be available to the distributors? Meaning, a Ford distributor can sell a Mahindra product, or how will it really work in terms of the brand synergy?
Yeah, so in India, it will be completely separate, and we will not do badge engineering where we do what you suggested. Outside, there may be markets where Mahindra isn't represented at all, where Ford dealer network could represent Mahindra in a separate facility or shop-in-shop scenario. So I think overseas is a bit more flexible. Here in India, it'll be completely separate.
All right, Indian markets seem to have digested the corporate tax rate cuts rather quickly. The initial euphoria has died down and Indian equities are back in the red. Foreign investors are still net sellers. So how do investors tread the markets right now? Who better than Mahesh Nandurkar of CLSA to give us that answer? Mahesh, thanks very much for taking out the time and joining in. Obviously, you would have had your own analysis on what this does for companies and how this affects their EPS growth, and then whether or not it's time to see a re-rating on some of the companies and some of the sectors on the basis of that. What would your end of year target look like for the index now on the basis of all that's happened over the last 2 weeks?
Well, good morning, everyone. What has happened over the last 2 weeks, especially referring to the corporate tax rate cut, is obviously a big positive. And while the theoretical EPS upgrade coming on the back of the corporate tax rate cut could be in the region of, say, 8 to 9% for, let's say, the Nifty as a whole, but the real EPS upgrade is actually going to be far lower than what the theoretical upgrade is, because of a couple of reasons. One is how exactly do the companies treat this corporate tax cut, and what kind of benefit get passed on through to the EPS level. And the second question obviously is there have been some pending earning revisions on the downside because of the much sharper slowdown that we have seen in the September quarter as compared to the June quarter. And the analysts have obviously sort of used that downgrade, which was potential and which was still waiting to happen, into the numbers. So the real upgrade is probably around 4% or so. And so to that extent, market did go up much higher, and now we have come back to a level which is about 4 to 5% higher than where we were before the corporate tax announcement. So I would say that the EPS revisions have broadly been factored in. But I would say that this is a re-rating event as well, which the market has not really given a due credit to just as yet. So therefore we remain optimistic, and our 12-month target on Nifty is about 12,500, so roughly say about 10% plus type of returns over the next 12 months.
All right. So while obviously this leaves some room on the upside for Indian equities, you need that large chunk of money to come in to drive interest back to those levels on the index. And so far, even if you have to analyze the last week's performance or last 2 weeks' performance post corporate tax earnings, again, it's a question of those big heavy hands that have been at play that have driven the index to levels of about 11,600 that it originally hit. So it's not like the rest of the market is contributing. It's not like the broader markets have turned around in a jiffy, or even for that matter, the bottom 30 weighted stocks on the index have done anything. It's just the top 10 stocks on the index which have done what they've done.
Yes, so there continues to be that polarization, of the market. We haven't really seen, the changes at the broader market level, and I guess that will take some time because the changes on the ground, the real economic changes will take some time. I mean, simply because the corporate tax rate has been cut, I don't think the companies really make changes into their plans straight away. So it's going to take a while, and as we have seen, the economic data over the last couple of months has definitely worsened. I mean, I would definitely say that September quarter YOY numbers are looking far weaker as compared to the June quarter. So I think that also needs to be taken into account. So my sense is that it's going to take a while, but we feel that probably the September quarter will be the quarter where we will see things bottoming out, even from the economic activity perspective as well, the GDP growth perspective. And from the December quarter onwards, we will obviously have the benefit, a little bit of benefit of the YOY comparisons becoming easier, and also the impact of lower rate cuts and better liquidity, etc., beginning to flow through in the system.
Mahesh, good morning. Neeraj here. Do you get a sense that your key clients might be inclined to or might show acceptance to starting to bet beyond the 25-30 performers, not just the Nifty but beyond as well? Even in banks, for example, we're still seeing the HDFCs and the Kotak banks doing very well, while ICICI and Axis had some days of uptakes. They've cooled off too, and the other ones keep on languishing. So even in the 35% of the weightage of the market, the preferences still haven't changed.
Well, see, the Indian market has generally, become like a hope market, right, over the last couple of years. And there has always been this expectation of, broader market rebound or the earnings growth rebounding, which hasn't really translated into reality so far. So a lot of investors, want to kind of, see the reality, before jumping in. So my sense is that, yes, there is some inclination, and clearly the valuation gap has widened between the leaders and the stocks that haven't really participated as much into the rally, also the mid caps versus large caps. And my sense is that trade is going to happen, I would say, over the next 6 to 12 months and probably beyond. But it's not going to start in a hurry because, as I said, now India has become the show me the money market, where people do want to see the hope actually showing, at least to some extent, into the reality.
What about the later stage financials? And sorry, let me rephrase my question. We've talked about banks enough. The ones which have performed really well are some of the non-lending financials. It's a small pack, but insurance has done fabulously well in the last 6 to 9 odd months. We're seeing asset management companies, even though there is only one notable name out there, doing extremely well. What's the house view out there, Mahesh, and what do you personally believe? Can there be more gains in this space, which seems extremely overvalued optically?
So, we as a house, continue to be overweight on the banks and financials. We still have, clearly an overweight stance on the private financials and banks within that, with kind of a well spread out, portfolio for the private banks, the retail banks, versus the corporate banks as well. Talking about the non-lending financials, which is the life insurance, general insurance, asset management, and so on. There is clearly, a view that this is, one sector which doesn't really have any headwinds, like some of the banking or the lending sector still has in the minds of investor, whether it is to do with NPL or whether it's to do with the worries on the margins, the NIMs, because as the leading state-owned banks start offering a repo rate linked product, it could pressurize the margins. So these are still the two concerns on the banking side, even on the private banking side. But on the non-lending side, clearly we don't really have any concerns. Yes, the valuations have gone up, but the business fundamentals are strong, and it doesn't really have too much of concern. So this is clearly emerging as one of the sectors where the valuations can look optically, on the expensive side. But I think, if we take a leaf out of what we have seen in the Indian markets over the last several years, I mean, there are a few sectors like consumer staples, consumer discretionary, where the valuations did appear quite expensive for a long period of time, and it still does. And my sense is that the non-lending financial as a sector is getting into that phase. So I will not really be too much worried because of the high multiples on that space just as yet, because it's just the beginning. And my sense is that the stocks can continue to deliver returns in line with the earnings growth, which are going to be, in my view, in high double digits.
So just to get this correct, Mahesh, you're saying that here on the re-rating may not happen on the valuation front for maybe the insurance companies, but earnings-led valuations may stay higher, and earnings-led momentum could give the stock returns. Am I correct?
Absolutely, absolutely. So I'm not really worried about the valuations being on the higher side. I think it can continue to remain at those elevated levels for a very long period of time.
Mahesh, almost a year ago or so, CLSA as a house was pretty positive on real estate and some of the bigger developers. Does that stance stay, or with whatever's been happening with regards to pressure building up on funding lines for developers, developers defaulting on loans to NBFCs, that stance changes a bit, or you modify it a bit?
Not at all. That stand, very much remains, on track. And over the last 12 months, as you rightly remembered, some of these property developers have actually kind of delivered sort of pretty decent returns and above market, despite the broader mid-cap or the small-cap segment has, done quite badly as such. So in the context of that, the property developers, most of which names are in the mid-cap segment, have actually outperformed, in a pretty decent way. My sense is that the events that you talked about, where there is some rising risk of some developers defaulting, or the possibility of some of them probably facing some kind of credit issues, etc., is all actually a relative good news for the names in the listed space, because most of these companies continue to actually benefit on a relative basis out of the stress that we are seeing in some of these smaller unorganized developers, etc., and the market share shift continues to happen. So even if one does not take a very bullish view on the real estate market as a whole, but definitely the listed developers, which is a very small part of that broader real estate market, can easily continue to gain share and deliver much better returns. So yes, to answer your question, we still continue to remain very bullish on the real estate developer space.
How much prominence are you giving to the wane on what's happening globally to domestic sectors like metals, which have really suffered at the hands of weaker cues coming about globally, the China-US trade war? We've not really seen that upcycle for them in a really long time.
That's true. So global cues are very, very important, because the markets don't necessarily just respond to the local developments. A lot depends on what's happening globally, and a lot depends on what's happening to the FII sentiments and the FII flows. And we clearly been having this view as our house view for last 12 months or even more, that the global growth is slowing down, and the concerns are kind of coming up on the growth expectations now in the US, Europe, China as well. And that obviously doesn't really bode well for the global commodities and the metal sector. So that continues to remain a big underweight in our portfolio. In fact, we're not recommending any metal stock at this point in time. So yes, so we are not kind of jumping into doing a bottom fishing on that space.
Just one more question that I had with regards to going back to financials, and what's your take on whatever has been announced in the recent past with regards to whether or not it means pushing back of NPAs that are in the MSME segments, to external benchmarking of loan rates, to the consolidation of PSU banks, so many developments in what we've been seeing in the financial space, and how does that play out for you?
Well, the way it plays out, to my mind, is that the financial sector clearly plays a very, very important role in the broader economic activities in the country, right? And so what makes us optimistic, on that space is that, one, we are clearly seeing the inflation remaining low, and therefore we continue to believe that there is a lot of room for the RBI to still cut rates. We expect, another 75 basis points, somewhere around that kind of a cumulative rate cut that RBI can possibly do in the current cycle. And we are just about begin seeing the transmission of the lower policy rates into the bank lending rates as well. And my sense is that that process will also be accelerated because of, one, we are now seeing reasonable level of liquidity in the banking system, which is very visible in the fact that the banks, as a whole, are depositing almost 1.3 to 1.5 trillion rupees, with the RBI under reverse repo. So that means clearly there is enough liquidity in the banking system. And the government has also started putting money into the equity capital of the state-owned banks. They've committed almost, kind of $10 billion. And my sense is, as a combination of equity infusion as well as ample liquidity, means that the transmission should happen, and the risk appetite in the banking and finance space should slowly begin to get normalized. So, currently we are clearly at a situation where there is huge amount of risk averseness, and that's the reason the money multiplier has also come down. But with these two things, reasonable liquidity and equity infusion, we feel that the money market, the money sort of multiplier will slowly begin to get normalized. The risk appetite begins to get normalized, and that's the reason why we feel that the economy might be bottoming out sooner rather than later.
Okay, Mahesh, time for one last question. I was thinking of asking you either IT or auto. I'm choosing autos because that's the more the in thing right now. The stocks are no longer at the levels that they were at before September 20th. Is there still merit in trying to own these names? Do you believe that there could be returns?
Well, we are still cautious. We are still underweight on autos as a space. But where I would probably like to start accumulating is the four-wheeler segment. I would still say that a two-wheeler is still not a very structural long-term story. Yes, you can see some small term bounce, and maybe the growth can bounce back up from a shorter term perspective. But it is still a sector that I'm not going to bet on with a longer term view. But yes, maybe the four-wheeler, the passenger car vehicle segment is where I will probably like to start. But it's not a kind of a decision that I'm going to take in a hurry. So, I can rather wait. But if I have to, then maybe the passenger car segment is where I will start buying.
I think your advice is well taken. Maybe people should rather wait, and nobody just has to. But Mahesh, it was so good chatting with you today on an important juncture for the markets. Thanks so much for taking the time out and being with us today.
Thank you.
Well, that's the view from an important market voice, CLSA's Mahesh Nandurkar. As we wrap, just keep in mind that banks have a very different trajectory today. While the Nifty Bank has recovered some bit of lost ground, and Yes Bank is up, ICICI Bank is up. So those are a couple of names which are doing well. There's still pain in Axis, in HDFC Bank, in Kotak Bank, and IndusInd Bank. So it's a very different trajectory, at least at the start, for some of the banking names. We call it a day on this leg of Indian Open from Devina and me and the team that has put this show together. Thank you so much for watching. Stay tuned. The FNO show takes forward the action on the other side.